Hi, everyone. We're very grateful to have you joining us here tonight for our Endowus Access live webinar. Tonight, we're going to be talking about unlocking your property's value of smart money tips. Just as a quick introduction, my name is Ee Chien. I head up business development and partnerships at Endowus. Previously, I was at Grab and Uber launching different financial products with them and started my career at Goldman Sachs Trading. Tonight, I'll be joined by Clive Chng. He is the Associate Director at Redbrick Mortgage Advisory, and I'll hand it over to him to introduce himself.
Hi, everyone. Thanks very much, Ee Chien. Thanks, everyone, for having me this evening. Yep, I am Clive. I'm an Associate Director from Redbrick Mortgage Advisory. So what we do over here, we are basically aggregators of the mortgage industry. So whenever you are looking to structure your loans or secure the best interest rates, we are like the Trivago, right, of the loan industry. So that's in short, that's what we do.
All right, great. So I think we'll go right into this. Just a quick disclaimer, since Endowus is an MEA's licensed entity, and I'll just go right to Clive introducing a bit about Redbrick. I will then be introducing a bit about Endowus, and then go straight into a couple of other topics that I'll talk a bit more about after this.
All right, thanks, Ee Chien. So yes, Redbrick Mortgage Advisory, we are the largest mortgage advisory in the market today. We not only broker mortgage loans locally in Singapore, but overseas as well. Till date, we have brokered about $25 billion worth of mortgages, which roughly translates to about $25,000, 25,000 properties. And moving on to the next slide, our value proposition that we provide our clients is really unbiased, personal unbiased advisory, right? So clients come to us with a unique situation based on our knowledge of the different credit policies that we have from the different financial institutions. We break it down for them. We structure their loans through strategic means and creative financing as well, make sure that they get what they're looking for. And we try to simplify the entire process, right? Make it easy for them to understand, and we'll guide them through the entire process, as well as continue to monitor their portfolios and help them expand their portfolios as well. So we hope to be like your mortgage managers or your mortgage partners when it comes to expanding your portfolios. So in short, this is what we do. Ee Chien, over to you. Yeah.
To what Endowus does really quickly, and then I'll cover the agenda. But Endowus really is here to help people to invest better so they can live easier today and live better tomorrow. I think for those of you who are unfamiliar with Endowus, coming from the Redbrick side, we're very grateful to have you with us tonight. We are a fee-based only wealth advisory. What that means is that we're paid only by our customers, and we're the first digital wealth advisor in Singapore to be able to invest all your monies, including cash, CPF, and SRS, which means that when you're looking at your wealth from a holistic perspective and into retirement, Endowus is actually able to provide that. The company's been around for about 4 or 5 years now, and we are funded and backed by some of the largest VCs in the world, as well as some strategic investors, including SoftBank, Lightspeed, UBS, and some of the other familiar names that you'll see like EDBI, as well as Singtel. So, I think we'll talk a bit about why our clients choose us. At the end of the day, Endowus structures its products in such a way, and the way we structure our company also is where we aim to give our customers the best advice possible. Because we are a fee-based only advisory, we are not incentivized to sell you crappy products, but rather give you the best products that will allow you to grow your wealth in the long term. The second thing is that we do give you access to institutional share class products. Just to simplify that or help you understand that just a bit better, essentially compared to what you might get at a bank, the pricing that we get, and this kind of ties in with cost, is that these funds are actually normally not accessible to the general public and only accessible to institutions, to big, companies like GIC or Temasek, etc. But we are allowing you and work with these fund managers to give you access to these funds. Lastly, unit trusts and a lot of the time people look at it from the perspective where you might get charged high fees, and that's not the case with Endowus. We don't have any sales charges. We don't have any transaction fees. And when we charge you on a yearly basis, any fees that we might get from the fund managers are actually passed 100% back to you. And so again, as the only provider for CPF, SRS, and cash investing at the moment, We wanted to structure our products in such a way that give you access to the best products at the best price. So before I jump right into what we're talking about right here tonight, I just wanted to lay out the agenda. I will be talking a bit more about how Singaporeans in general, or even people beyond Singapore, to a certain point, are really asset rich and cash poor. After that, I'll be handing the time over to Clive to talk about mortgages, and then talking about how you can utilize the equity in your home to be able to really maximize the cash and as well as the assets that you have on hand. And lastly, after Clive completes that section, I will be talking a bit more about how to broadly manage your wealth with that extra money that you might have. So I think I'm quite excited for this because it really talks about money from a holistic perspective and really unlocking all the money that you have, whether it is cash or whether it's something that you might consider to actually be something that you can't utilize. But I think Clive's got some cool tricks up his sleeve to share a bit more with you on that. So my first section here is pretty quick, so I'll jump right into it. So I think the first question is, what does it mean to be asset rich and cash poor? So if we look at the hypothetical example of a couple in Singapore that's getting close to retirement, and as you guys well know, 55 years old is right when you complete your contributions into your ordinary account. These are people who actually have a substantial amount of their money in property. So, this couple has spent a good amount of time working. They have been able to pay off their HDB flat, which is close to $700,000. And in terms of the retirement funds that they have from, a CPF perspective, they're actually doing quite great, right? Because they have $130,000 in their CPF OA account. Their MediSave is pretty decent. That takes care of their healthcare. And then lastly, they have their special account, which will combine with their ordinary account to form their retirement account. And then they have a bit of money in investments, but unfortunately have not too much in their bank. So if you look at this, their total assets is actually a lot of money, right? It's $1 million. That's 7 figures. And they are hypothetically, in that perspective, millionaires, right? Because from an asset perspective, they have $1 million. The problem is the chunk, or the huge chunk of that, a big chunk of that is really in their property. And in terms of the retirement itself, they actually only have $350,000. And let's not forget that actually a chunk of it is also in MediSave. So they really have less than $300,000 in cash or in terms of retirement funds to be able to live. I mean, this couple, I'm sure, has done a great job of taking care of their kids and providing for them. But now it's time for them to take care of themselves also. So if you look at that big red circle, the cash in bank is actually something very low, even though the money that is rather illiquid actually adds up to a lot of money, right? And so if you look at this from a percentage perspective, this really gives you a good sense of where they're at. And this is unfortunately somewhat typical of a decent number of people in Singapore, where their money is locked up in assets, and that is fairly illiquid, currently, but rather they are, cash poor. So if you look at this, 1% versus 99%, they've worked hard, but they've locked it up in hard to monetize assets. And in that sense, they're living paycheck to paycheck from the salaries that they are making, right? So, what do you want to do? And so if you look at this is the reality, right? So this was a survey that was done by OCBC that 2 in 3 working Singaporeans do not have enough savings to last them beyond 6 months. And so if you're looking at that from the perspective of the median income in Singapore, which is about 4,500, and around that up to 5,000, you've got that, say 5,000 times 6 is 30,000 times 2 for a couple. That's not a lot of money. That's only $60,000. And 60,000 over a period of time that you need for retirement is a long time. Note that you are accumulating your wealth over a 40 to 50 year period, and then you have to decumulate after that, assuming you don't want to work till death, and you want to enjoy your life and your retirement just a bit. And so you really need to think about how you can maximize the equity or the money that you might have, whether it's cash or whether it's something else. So I think right before I hand it over to Clive, this is the last slide. It's really talking about whether it's better to have assets or whether it's good to have cash. So let's kind of like break it down, okay? You've got the left side where you're looking at the cash, and cash is simple, right? Cash in the bank is insured against loss. The SDIC, the Singapore Deposits Insurance Corporation, ensures that no matter what happens, you will be protected up to $75,000 in case the bank goes bust. And honestly, cash is good in the sense that it's affected less by the market. But what issues do you get with cash? And I think it's something that's actually pretty front and center in the moment. And the answer to that is inflation. So inflation over the past couple of months and going into the next few months is projected to be going up quite a lot. And what inflation does is, and what inflation is when you have more demand than supply for goods, which is happening in the world that we have currently with the volatility from supplies for both COVID as well as the Ukraine war at the moment, means that the value of your dollar today is worth less tomorrow because the value of that money actually depreciates if you keep it in your bank account. And so the reason with that is when you're accruing such a low interest rate in your bank account, you're not making enough to keep up with inflation. From an assets perspective and in terms of investing it, two things that are great, right? It can appreciate in value a lot faster in comparison to cash, and it can be used to generate income. So if you have enough money in the bank, you can actually use that to generate income for yourself. But the problem with that is that to a certain point, it can be illiquid. It can be hard to monetize. Whether it's a fixed deposit, whether it is something that you're having in terms of real estate, and you have to make sure that you are willing to take the volatility, as it says over here. Assets can be subject to market conditions. I remember my parents, they had bought property, and I think right after that, it went down for like 10 years or something like that, right? And so the market can also turn, and we've seen that the markets were at all-time highs towards the end of last year, and then right around December and January really took quite the dip of 10 to 15%. And so you really have to demarcate different amounts of money, which are more safe, and then money that is you're able to utilize that is a bit more volatile. So I think with that, I'm going to hand the time over to Clive to share a bit more about mortgages and then essentially how you can use some of that money that you have locked up in your property to be able to liquidate that and use it for yourself. Thanks. Over to you, Clive.
Thanks very much, Ee Chien. So I think it's very important to diversify or have a diversified portfolio. And I think most of us in Singapore, we a large part of our monies are locked into properties because and that usually is our largest liability. So the topic today is to find out what are the different ways to unlock your property's value. That's the overarching theme. But before I go into that later, I would just like to give you guys a current market update on what's happening in the market, what are the trends that are going on at this point of time, so you can have a good idea as well. So as what Ee Chien mentioned, if you don't already know, interest rates are climbing. Earlier this month itself, the U.S. Federal Reserve has increased the benchmark interest rate by 25 basis points, and this is first of many increases that we are going to expect that's going to happen this year alone. And the reason for that is what Ee Chien mentioned. Inflation is really high. If you look at U.S. inflation, I think in the month of February we're looking at 7.9% inflation. In Singapore itself, I think headline inflation is above 4%. And in fact, if your mortgages today, if you refinance into a floating interest rate, for example, and it's below 1%, you essentially might be borrowing for free as well. So moving forward, this year alone, we are expecting a few more interest rate hikes that are coming from the US Feds. Some analysts locally predict 4 or 5 increases within the year alone. And moving into 2023, another 4 more increases. So if you haven't yet refinanced, or if you're packed to a variable interest rate on your current mortgage, then I think it's a good time for you to start considering your options. I just want to bring the conversation back to 2017 and 2018. That was the first time when the US Fed started hiking the interest rates ever since the global financial crisis, more aggressively in 2018 and 2019. So back then, the narrative was, okay, in 2018, I think the economy is doing better. Let's raise interest rates and see what happens. So it was a very mild kind of a narrative. Let's wait and see what's going to happen. And as we approach 2019 as well, at the earlier part of 2019, the narrative was, okay, things are looking good. We might increase interest rates again. And that narrative suddenly changed as we moved towards the mid of 2019 to sustain growth. We saw interest rates cut. This time round, even before interest rates started hiking, I think there was a lot of speculation, there was a lot of talk about increasing interest rates already, even before the rates first moved Goldman private banks like JP Morgan and Goldman Sachs were predicting 9 rate hikes within a year alone. So if it's anything, we can expect that rates will move rather aggressively this year, right? So, first major trend, a lot of people are moving from their variable interest rate packages into fixed mortgages at this point of time, whether is it a 2-year fixed interest rate, a 3-year, or even a 5-year fixed interest rate. Because in a rising interest rate environment, you just want to hedge at the current cost, and that gives you a very stable cash flow. And this is very natural in a rising interest rate environment. Back then in 2018, when interest rates were first picking up, we also saw the same trend. So similarly, we are looking at this right now. More people are looking at moving to fixed interest rates. Now, number two, interestingly as well, what happens is that whenever you refinance, or if you have a current mortgage and you're refinancing your mortgage, there is always an ability for you to extend your loan tenure, right? And why do people, and there's a trend that people are always extending a loan tenure now. Now, why is that so? If you look into the market, and you compare a fixed interest rate versus a floating or variable interest rate, it is as large as this. Fixed interest rate 1.85%, and you can get a floating interest rate as low as 0.82%. That is a very, very, very big gap. This is not normal. Generally, the gap will narrow. And when you're looking at fixed versus floating interest rates, you're looking at a gap of 30, 40 basis points. So what some people are doing, number one, is they're opting to go in for floating interest rate and also stretch the loan tenor. Why? They see that the difference of 1% is very huge, especially if you have a million, 1.5 million, $2 million loan, right? 1% difference in interest rate makes a very big difference in your interest savings. So in the meantime, they would want to capitalize on this low interest rate of slightly under 1%, and they would stretch the loan tenor right to the maximum. And when you stretch your loan tenor, automatically your monthly installments drop because your loan is now amortized over an additional number of years, and your cash flow becomes more manageable, right? So they are expecting interest rates to increase, but when it does increase, because I've started with a slightly lower monthly installments and interest rates increase, I'm still able to manage my cash flow, right? And on top of that, they move into floating interest rate packages because it provides a little bit more flexibility than fixed interest rates. For example, certain floating interest rate packages come with a 1-year lock-in period. If you're looking to sell your property, or if you're looking to make a partial prepayment after 1 year, that's a consideration as well. And the second group of people are going for fixed interest rates to hedge against rising interest rates, of course, and stretching their loan tenors as well. Same thing, this improves their cash flow. And because you can secure a 3-year fixed interest rate, for example, at 1.85%, generally when you look back in the last 5-6 years, 1.85% is rather decent, right? It's still considered quite okay. We're not talking about 2.4 or 2.6% when we saw that in 2019. So everyone is trying to lock in, stability for the next 3 years and improve their cash flow by stretching the loan tenor, and they start deploying their cash elsewhere, right, to get better returns, to get better ROI, right? Knowing that we have a very predictable cash flow in the next 2 or 3 years. So this is the second trend that we're observing as well. At this period of time when interest rates start going up, we do often get a lot of people coming to us and say, Clive, because interest rates are going up, I would like to make partial prepayments or lump sum repayments on the property because, I don't want to incur a lot of interest and I want to be able to clear my loan as soon as possible, right? And there are two groups of people. First group of people would say, I would like to use CPF for partial prepayments, right? But what I will tell you is that, your money's in your CPF account. For example, if you're looking to use $100,000 to prepay on the property, $100,000 sitting in your CPF ordinary account is virtually earning you a risk-free return of 2.5% per annum, right? Your mortgages today, for example, if you go in for a 3-year fixed interest rate, it's at 1.85%, right? It would be a little bit more efficient to leave your monies in your CPF account because you can then enjoy a higher return. And if you decide to deploy your CPF later on into other alternative investments that give you a high return, then it's better that you do it that way. Now, the other group of people would say, Clive, I don't have any CPF left. I have a lump sum of cash in my bank account. It's sitting there earning a very miserable interest from the banks, and I would like to use that to prepay on the property. Well, the question that I'll always ask you, and I would like to have you guys ask yourself, is when you do that, have you used any CPF on the property itself, right? So you've bought a property, chances are majority of you would have used some CPF on the property, right, at the beginning stages. A consideration would be refunding, right, the amount that you've used on CPF back into your CPF account, right? And when the monies go back into your CPF ordinary account, it then accrues at 2.5%, which is higher than what the mortgages are, the banks are charging you on the mortgages today, right? So the name of the game is to always try to make your monies work harder for you. Okay. And alternatively, if you say, hey, you know what, Clive, I don't want to put my monies back into CPF, there are always tools out there available in the market that allow you to lower your effective interest rate, because that is, after all, your main point of paying down on the loan is to save on interest. There are tools out there that will allow you to save on interest by lowering your effective interest rates, right? By utilizing your liquid deposits. So basically, your money sitting in your bank account works harder for you. There are certain tools out there that help you do this. Now, lastly, we have also observed a growing number of people who own private properties who are looking to extract equity from the property, and we'll cover this shortly after this. What they're doing at this point of time is to extract as much equity as they can based on today's interest rates, right? 1.85%, 3-year fixed interest rate, for example, and they're deploying this cash into investments or instruments that can generate a higher return on investment, right? So basically, their thought is that, you know, Clive, when I get an equity term loan, in this case, by releasing equity, the banks charge me an interest on that. So let's say 1.85% fixed for 5 years, fixed for 3 years. But because this is very similar to a mortgage, the interest is being charged on the reducing balance, right? Because the loan is amortized, right? So this makes sense, right? I would borrow this amount, it's amortized, I pay less. I mean, it's not like a simple interest, and I'll use the money to generate better returns. So this is almost a no-brainer for many people who are invested into the market by taking an equity term loan from the property at this point of time. Now, that is the general trends that we have observed at this point of time in the market. And let me go into probably also covering the interesting portion on how do you actually unlock value from your property. There are many things that we can cover, many ways we can structure the loans to help you unlock equity from the property, but I'm just going to classify them broadly, give you some very simple examples, right? You can extract equity directly, indirectly, and also through efficient loan structuring, you can realize your property's value as well. Let's go into the examples.
Clive, just a quick one also. There's actually a question that would be quite relevant that was asked on the Slido as you're covering this. Okay. So the question is actually this. I plan to maximize the available equity term loan by using existing fully financed property as collateral. What is the best age to do this? So I think you might want, if you cover
yes.
it perspective, that'd be great too.
Yeah,
thank you.
I'm actually going to cover it in this slide, just nice, right? So I'll answer your question when we go through the next few slides, okay? So extracting equity from the property. Over here, we have an example, right, where this client is 45 years old. Current market valuation of the property is $1.5 million. She has an outstanding loan of $500,000, and she has used some CPF. Principal accrued interest adds together to become $200,000, right? So how do you actually release equity from this property? Is via an equity term loan, right? So basically, you don't have to sell your property. You remortgage your property back to the banks, and the banks will give you a lump sum of money. In this case, $425,000. Then answering the question, Ee Chien, that one of the audiences just posed, in terms of the number of years, this is the calculation, right? You can borrow up to the age of 75, right? This is a little bit different as compared to getting a housing loan when you first purchase your property, because when you first purchase your property, you would be looking at a loan tenor of up to the age of 65. But over here, for an equity term loan, you can actually stretch the loan tenor to up to the age of 75 or 35 years, whichever is lower. So in this instance, Min Min being 45 years old, she's able to get an equity term loan of $425,000 over 30 years. And if you look at the monthly repayments, 1.65% is what you'll get for a 2-year fixed interest rate today. Your monthly installments every month, about $1,500. $1,500 for $425,000 of equity in exchange, I think is a really good deal. And also looking at inflation in Singapore as well, I mean, you're paying 1.65%, but because of inflation, you won't be paying 1.65. It's actually cheaper than that, right? So there is no other way in the market where you're able to release this amount of equity at such a low interest rate, right? The only tool available for you out there is really by leveraging on your property to do this for you. Okay. So let's go to some fundamentals of equity term loan. How did I even derive that $425,000? And you can just by this slide alone, you would be able to figure out how I did that. So you just take the valuation of the property at 75%. You net off whatever outstanding loan that you have or whatever CPF you have on the loan, and the residual value would be potentially the amount that you can extract. Why potentially? Because you still have to meet some other requirements as well. Okay, so this is a very simple formula. You can, if you have all the other information, you can plug in the numbers and you can forecast how much equity you can actually release from your property itself. Now, there are some benefits of taking an equity term loan. Number one, the interest rates that you get on your equity term loan are similar with your housing loan interest rates, right? So if your housing loan interest rates, you're getting a floating interest rate of 1% or slightly less than 1%, you can have your equity term loan pegged to that particular interest rates as well, which is very low. Number two, you generally get a higher loan tenor, right? Up to the age of 75 or 35 years. This is slightly different from a housing loan. When you're purchasing a property or when you're refinancing your housing loan, the formulas are also different. So equity term loan tends to give you a longer loan tenor. And it's very important to also know, and this is a really, really important point, that an equity term loan is essentially not a housing loan. And if you understand the current loan to valuation regulations in Singapore, where when you purchase your first property, you get 75% loan, and if you have already one existing mortgage and you want to take on a second mortgage, the maximum loan the banks are going to grant you is 45%. Then you would know if it's not a housing loan, if it's only an equity term loan, then you can figure out what is the LTV or the loan to valuation you can get if you're purchasing a second property. Now, one thing that you're subjected to for an equity term loan is that you have to pass your total debt servicing ratio. Okay, and the total debt servicing ratio, ever since the last cooling measures were announced, has dropped from 60% to 55%. So this just means that your entire, whatever commitments that you have, whatever obligations that you have on a monthly basis, cannot exceed 55% of your income. Okay, so you must have the ability to support the equity term loan as well. Now, what about, you may be asking yourself, hey, I'm 60, my spouse is 65 years old, we have retired, we are staying in a landed property and it's fully paid, right? The current market valuation of this property is $4 million and we don't have any CPF usage on the property. Are we able to then get an equity term loan, right? Then I'll tell you one of the requirements earlier that we mentioned is that you have to pass your total debt servicing ratio at 55%. And in this case, because they are not working, they're retirees, they don't have an income. So they don't fulfill this requirement, right? Are there ways around this? Are there banks that would allow, or we can structure the loans in a certain way whereby retirees can also extract equity from the properties? Of course, not all banks would do this. You need to know which banks to go to. But generally, because you don't have an income, then it's going to be a little bit more challenging for you to extract equity. But we can extract equity if, for example, in this case, Jack and Hazel has a daughter, okay? And the daughter is already working. Generally what happens is that the banks will say, okay, if you have a daughter or a son, you can consider getting them into the property as well as a co-owner, right? So in this case, Isabel is the daughter. Isabel can go into the property to purchase 1% share to also be considered an owner of the property. And if she's an owner of the property and she's earning an income, she can then extract equity from the property itself. However, if Isabel intends to buy a property under her own name, let's say it's a first property, right? Under a condo, for example. In the eyes of IRAS, they would look at you and say, okay, you already have 1% share, you already own one property, the condo will be considered your second property. And because you are purchasing this second property, you're going to have to pay additional buyer stamp duty, right? And today, for Singaporean citizens, second property additional buyer stamp duty is 17%. It's $170,000 on $1 million property, right? It's going to be a hefty amount. So how do we then go about extracting equity and also buying another property without paying additional buyer stamp duty? Can we structure it in this way, where Isabel goes into the property not as an owner, but only as a borrower? It is possible. It is possible, not for all banks. But in this case, Isabel can go into the property to extract equity without being an owner. And because she is not an owner, if she buys a property under her name, that property will be considered her first property. And then that additional buyer stamp duty requirement of 17% that does not exist anymore, right? Because Singaporean citizens, first property, no additional buyer stamp duty, right? So there are banks out there in the market that allow this according to their credit policies. It's just that, that is why it's important to structure the loans properly. It's important to understand what we can do and what we can't do to basically extract equity from the property. Okay, so in this case, for Isabel's instance, she's able to release up to 45% of the valuation of the property. So that works out to be a $1.8 million in cash. Of course, subjected to TDSR, based on her income, she must be able to support the loan of $1.8 million, right? And also subsequently, if she's buying a property under her own name, her commitments on the equity term loan would be taken into consideration as well. So that would eventually affect her loan eligibility, right, if she's purchasing another property. So the numbers and the figures have to be worked out properly as well. Okay, let's move on. So that's the first way of extracting equity from the property, the most straightforward way. Let's move on to a slightly more indirect way, or something that people don't really think of sometimes. Now, what if you don't qualify to, or what if there is no value on the no residual value on the property for you to release? For instance, this example over here, married couple Celeste and Jason, they own 50% share in a property that is worth $1 million today, and there is an existing mortgage of $500,000. Now, if we look at Celeste's part, because she owns 50%, she owns $500,000 of the property, right? So half of $1 million. And because she also owns 50% of the property, she shares half the debt of $500K, which works out to be $250,000 as well. And she has not used any CPF on the property. If you look at Jason, same thing, but Jason has used $250,000 of his own CPF when they were purchasing the property. Now, if you go back to the calculation that we had just now on how to determine whether you can release equity from the property or not, we take 75% of the market valuation and we less off whatever outstanding loan and CPF. Let's take a look at that example and see whether there's any equity to be released, right? So for a market valuation of $1 million, we multiply that by 75% loan to valuation. And after netting off the outstanding loan and CPF, you realize that there is no equity for you to release at all. So then what are we supposed to do? Now, many a times we don't think of it, but when we first purchase, for example, our first private property, we may be starting our careers, we may be fresh graduates, for example, or we may be working in the workforce for a couple of years with some cash savings and some CPF savings. But after a few years, 4 or 5 years, our income has grown, our earning power has grown, right? Because we have progressed in our jobs. And we then are able to actually, when we do the numbers, either Celeste or Jason has the ability to buy a property under their own names or to take over the outstanding mortgage under their own names. So in order to release equity, what we can do is called a decoupling, right? And this is quite a common term. I'm pretty sure a lot of you have heard about it. But this is one way to release equity as well. And this is going to be the example. So we're going to say that Celeste is going to sell her share to Jason. Okay, she's going to decouple the property with Jason. So what's going to happen is that Jason is going to buy over Celeste's shares of 50%. So let me focus your attention on Jason's part on the right first, where Jason buys 50%. He buys over the property. PP is purchase price at $500,000. And we follow the normal loan structure. When you purchase a property today, it's going to be 5% in cash, 20% in cash or CPF, and you can take on a mortgage of 75%. So the down payment is going to be 25%, which works out to be $125,000. And Jason then takes on a loan of 75%, which is $375,000. And because he is buying over the share from Celeste, he needs to pay buyer stamp duty on that $500,000 as well. And Celeste sells her share on the left, $500,000. She has to repay the existing mortgage of $250,000. And technically, she's supposed to get $250,000 back in cash, right? So let's focus on the middle portion at this point of time. So Jason has used 25% to buy over Celeste's shares. And because they're husband and wife, 125 each, it's kind of like a left-right pocket. So after netting off the buyer's stamp duty, the net cash that Celeste is going to get, it's going to be 115,400, right? And Jason would then own the property under his own name. So this is another way that we can extract equity from the property and still stay in the property. What are the downsides of this? Some people may ask me, Clive, what happens when we decouple? Then Celeste doesn't have a share in the property anymore, right? But this is the most financially efficient way of extracting equity from your property while still living in the property itself. Okay. Now let's move on to the last one because I'm aware of the time as well, about loan structuring, and this is quite interesting as well. I'm going to give you a very simple example. So a married couple, a Singaporean citizen and a Singapore PR, they came up to me and said, I want to own a property each, myself and my wife. We're going to use one property for our own stay and the other one for investment. Okay. So this is the scenario. Singapore citizen is going to buy a condo under his own name, first property purchase, and there's no additional buyer stamp duty because it's his first property purchase as a Singapore citizen. However, his wife, for example, is Singapore PR, and as a Singapore PR today, you would have to pay an additional buyer stamp duty of 5% on the purchase price or the valuation price, whichever is higher. Okay. Now, assuming that this property is worth $1 million, it costs $50,000 more for his spouse to own this property because of additional buyer stamp duty. Okay. Now, is this the best way to do it? Well, the answer is no, because you're going to have to pay $50,000 and everyone wants to avoid paying additional buyer stamp duty. So how then do you go about owning two properties and pay as little additional buyer stamp duty as possible? I'm not going to teach you something that's illegal. Everything that I'm going to tell you about is always within the legal boundaries. Everything is safe, okay? So instead of buying a property individually at the very beginning, you buy it together, right? Jointly as a matrimonial property. And a matrimonial property, because there is a Singapore citizen in the picture, you don't need to pay for additional buyer stamp duty, right? So that solves the first part, okay? And when you hold a property today, there is a different manner of holding that you can hold it in, right? A manner of holding basically means the number of the percentage that you own in the property itself. And it's very common, commonly heard in the market that, oh, you hold the property in 199, right? Very common. Is there a reason why people want to hold it in 99.1? Yes, of course, because it's more efficient later, and I'll show you why. But does it have to always be 99.1? The answer is no, right? And that will be a different discussion for a different day. So they first buy a property jointly under both names, hold in a manner of holding that we call a tenancy in common, which is specific shares that the individuals hold. And in this case, the husband, who is a Singapore citizen, would hold 1%, and the wife would hold 99%. Now, what's going to happen later is that they're going to decouple on the property, like what we saw with Celeste and Jason earlier, right? Decoupling from the property. Husband would sell his share to the wife. So on the left-hand side, husband sells 1% of the share. Now, assuming that this property is worth $1 million, 1% is equivalent to $10,000. And all of us know that when we buy a property today, and if we sell the property immediately, like we flip the property, there's going to be a seller stamp duty. In the past, they didn't used to have a seller stamp duty, so many people flip the properties. But today it's very different. If you're selling the property within the first year, you're going to be charged 12% seller stamp duty. But it's only going to be 12% on the 1% that I'm selling away. So that's equivalent to $1,200. Now imagine if you have owned this property in equal shares or joint tenancy, 50-50. You're selling your property away at $500,000. Then you're going to have to pay seller stamp duty of 12% on $500,000. And that will make a drastic difference. Hence 99.1 as well. Now, on the right-hand side, the wife buys over 1%. Basically, she issues a check for $10,000, issues it to the husband. She pays for buyer stamp duty, but buyer stamp duty is only paid on 1% share, right? So buyer stamp duty on $10,000 is equivalent to $100. If the wife would have bought or owned 50% shares and bought over $500,000, then the buyer stamp duty will be about $9,600, right? So we've saved some monies over there as well. Next, additional buyer stamp duty is only paid on 1% as well, right? So additional buyer stamp duty is 5%, 5% of $10,000, okay? And then, of course, there are some legal fees and valuation fees involved in the entire decoupling, which costs about $6,500 in total. But let's look at the end state. The end state is that you can purchase a property under your sole name if you're a PR and pay additional buyer stamp duty of $50,000, or you can do it the way that we've just proposed, purchase it jointly and then do a decoupling, and you only pay $8,300 in terms of fees. So the name of the game over here is that there are many ways to skin a cat, right? And of course, it's talking to people, knowing what is being done out there, to understand what are the different things you can do to own a property in the most efficient manner. And all of us just want to own our properties in the most efficient manner, because when we free up cash, we can potentially use the cash to diversify, right? And to use the cash to generate better return on investment, which is what Ee Chien is going to share with you in the next slide. So I think this is all that we're talking about so far, is how are you able to own your property in the most efficient manner? And after owning your property in the most efficient manner, how are we able to leverage on what we've owned, on the down payments that we've made, on the money repayments that we have on our mortgages, on the capital appreciation of the property? How do we extract the value out from a property, right, without selling it, for example? And that is what we have just covered. So once we have extracted equity, then the question comes into play: how do we then use what we have in cash? How do we then grow our monies? So with that, I'm just going to hand over the time to Ee Chien right now to share the next part of the presentation.
Great, Clive. Actually, before I start sharing a bit more, there are some questions for you. I think some people are quite excited about what you were sharing about. I think
Sure.
She tried to answer one or two of them, but I think there's still quite a lot to cover.
Sure.
So a few different things here. How does Redbrick charge me if I engage Redbrick to broker a suitable mortgage loan of the banks for me?
Yeah, we don't charge any fees to our clients, right? So now the way the business is structured, or the way things work in the market today, is that the banks will remunerate us for every recommendation or based on the loan quantum, right? So in a way, you can think of it like that. The banks outsource the job to us because it sometimes is not the most efficient to hire a team of 500 people, a mortgage specialist, to solicit for business and pay everyone a basic salary and a commission. It is, for the lack of a better word, cheaper to go through us. Because whenever we whenever we have a deal whenever we go to the banks, there is always a deal on the table, right? And banks acknowledge this. Banks do acknowledge that when we speak to our clients, we help them structure the loans. It's much more efficient when it goes to the banks because the loan structure would have already been figured out, and all the banks have to do is just process the case, right? So in return, they remunerate us for that, and that's the reason why our clients don't have to pay us anything.
Can an industrial property do an equity term loan?
It depends, yes, right? It depends how you hold what is the manner that you're holding the industrial property in. If you've bought it under your individual name, if it's bought under an investment holdings company, do you own the industrial property and you're running a business out of that? So it really depends. There are many factors, but there is a potential that you can cash out or do an equity term loan from industrial and commercial properties as well. Yes.
Fantastic. We've got three more questions, two that I can bunch together and one more after that. So Isabel was quite popular from your examples. So the question is, what if Isabel buys her own property first, then purchases the 1% share? So ABSD will be on the 1% share of the land. Does that work? And I think you had shared a bit about that, but maybe you should just clarify.
That's right.
Secondly, going back to Isabel, does it have to be family, daughter here in this case, for equity term loan release, or can it be anyone else? Basically, does it have to be within the family, or can it be anyone?
So let me take the last question first. If you're talking about what we mentioned earlier, there were two different ways that we can extract equity. One is to be an owner, and the other one is not to be an owner, right? Let's talk about the one where you don't have to be an owner. If you are not the owner of the property and want to extract equity, you have to be blood related. Okay, so that answers that question. Now, if you're extracting the property by being an owner, then it doesn't matter, right? You can be friends, right? And I sell 1% of my private property to my friend. And as long as my friend is employed, he has an income, he's able to extract equity from my property. Yeah. So the second question would be, Isabel has to be blood related to be able to extract value from the property without being an owner.
Great. Then just maybe one more question, or two questions, I guess. Maybe quick answers, but any way to unlock equity for a house under construction? And is this also applicable for HDB flats? And sorry, last question is about at 56, we hit FRS in our retirement account and did VHR and SA shielding. Can we still withdraw our lump sum VHR from OA and received annually from
I don't know whether the last question is relevant
Actually,
to
I tell
me.
you what, Xingxi will answer that question, but I think maybe just
Yeah.
two quick questions. Any way to unlock equity for a house under construction, and is it applicable for HDB flats?
Yeah, so let me answer the second one first. No, it's not applicable for HDB flats. There are a lot of restrictions that govern government housing, right? I think that, I mean, it has already been reported in the market on the news agencies that the government doesn't want you to think that, your HDB or to view your HDB as an investment, right? But so I'll stick to that narrative because I don't think MES would be very pleased if you watch this video and I'm advocating something else. So that's the straightforward answer. There are definitely creative ways where you can extract equity from your HDB, but that's a different discussion for another day. Let me go back to the first question: is if you can you unlock equity from the house under construction? Potentially, yes. Not many banks can do it. It depends on the stage of the construction that you're in as well, right? And it depends because recently I've just concluded one case like that where my client who is the property is almost reaching the temporary occupation permit phase, but because there has been an increase in the capital appreciation of the property and he has not taken a loan where everything was fully paid in cash, yes, he was able to extract equity from the property. Yep. I think you're on mute, Ee Chien.
Yes, we had to just unmute me.
Yeah.
But we prefer your voice, like Clive, so prefer to hear you. But okay, I think we'll just round up here. I think for the next 5 or 10 minutes or so, and talk about the importance of investing and managing your wealth. I think the reason why we want to talk about this is really to help people to understand that if you do unlock this money, at the end of the day, what you want to be able to do is be able to utilize that money intelligently, right? And not deplete that money very quickly. At the end of the day, I think when people are looking at unlocking their wealth or unlocking the wealth that comes from their property, it really is to live better into their retirement, because that's generally the time in life that you do that. So I think just a quick one to cover really quickly, there is a big difference between saving and investing, right? And in the context of this, essentially, if you're pulling that money out, this is money essentially that you have saved, right? Because it's been in your property, and now you're utilizing that. The difference is if you use that money immediately just to, pay for a really cool car, or you use it to go on a really nice vacation and all that, sure, that does give you some, rewards, I guess, from an emotional perspective. But it really is about using that money smartly, and investing it so that you can actually use that money over a longer period of time. So there are a few ways that you can do this, right? One is you can look at it from the perspective of putting it in a cash management account, right? So Endowus actually has cash smart products where you can actually put it in there and you get a better interest rate, generally speaking, than your bank account. And what you can do is you can actually move that on a monthly basis to your Endowus investment account to make sure that your dollar cost averaging in. We also don't espouse you all the time, maybe dumping all your money into something that, leans a bit more towards equities that can give you a higher return, but also has more risk. And so you want to structure it in such a way where you're putting in that money to give you higher returns from the money that you have pulled out of your property, and be able to grow that. So if you look at this chart, those savings really, if you're pulling that money out and say you're still living for the next 30 years, right? At 55, Singaporeans have an average lifespan of 80 plus right now. So you really do have 30 years left. And you want to be able to make sure you utilize that money properly. Okay. And so even though people have been saving up, they don't feel prepared. And we talked about this at the beginning, right? From a retirement perspective, people don't have enough money. And that's why using that home equity loan might make sense. But again, keeping that money in cash is not risk-free. As we talked about it, both Clive and I, about inflation, you really have to make sure that you're looking at it from the perspective that you manage that money so that you are not losing to inflation, which would actually be quite sad, okay? But a lot of people might say, wow, I'm pulling out that money. Why would I ever invest that? Because it's a huge chunk of change. Say it's $500,000, $600,000. If I invest it, I might lose all my money. And I don't know what to do. So I'm just going to keep it in cash and deplete it. But that's the thing. If you deplete it too fast and you don't have that money being invested, then that's where you might end up at a point in time where maybe you're lucky, okay, you live very old, 80, 90 years old, and suddenly you don't have any cash. Whereas if you have invested it, it will continue to give you returns and allow you to stretch your dollar till till we all kick the bucket, I guess. So I think if you look about it, people really don't think they have enough money for retirement. And so we want to help you to understand how you can prepare for your retirement now, and then also look at it from the perspective of using the home equity loan. So you can look at it as a combination of both, right? To have saved and invested enough money to at least have a decent chunk of change, and then couple it with your home equity loan to really give you a holistic basket of money for your future. As we said, inflation makes life more expensive. If you think about it in 20 years, can you imagine if you're doing your makan, right? And it goes from $1 to 152, that's 52%. And healthcare, as you get older, in the past 20 years has also gone up by 60%, right? Hopefully you're not paying for your kids' education in 20 years. So even though that does go up in terms of inflation, hopefully it's a bit better for you. But again, most people are not investing their money properly. And so we want to make sure that people are making those right choices. I'm going to cover 5 main points about this, and then we should be close to the end. So, individual investors, when they look at investing, they have it tough, right? At the end of the day, for them, when they're trying to invest their money, they don't know how to make those choices, and they end up investing in such a way where they might end up losing money or really not being just above inflation. But if you look at it from the different spectrum of products that you can invest in, there are a lot of other ways that you can do it in such a way where you can have enough money for your future. So the first thing here really is about cleaning up your finances. And this is actually really good, right? Because if we're looking at it from a home equity perspective, you actually want to know how much money you have. If we looked at that, I guess first or second slide, it showed that couple that actually didn't know how much money they had, right? They had X amount in their property, they had X amount in cash, they had Y amount in CPF, etc., and all that, right? And so being able to understand that in context of your debt, how much you have to pay, whether you still have enough, whether you still have to pay back money to your your mortgager, whether you have a credit card debt, whether you have to have some sort of student loan debt, you need to make sure that you pay that off. And setting up the emergency fund to protect yourself is great. So investing with intention, investing to make sure that you have enough money for the future, or to invest to make sure that you can stretch your dollar from your home equity loan, then that's something that you need to think about. And when you look at the amount that you need from a longer period of time, or at the end of your life, or at the end of whatever period you have, and working backward will then allow you to know, 1, how much you need to save, 2, how much you need to pull off your home equity loan, and how much you need to invest to be able to utilize the money to the best of its ability. And what I mean by that is the money's ability to grow. The third thing is diversification, right? So I don't know, you might be tempted to, when you pull out $500,000, say, all in on crypto, all in on Bitcoin, all in Tesla, all in AMC, all in GameStop, right? These are stocks that are quite hot and that have gone up hundreds of percent. And you think, man, if I pull out $500,000, fantastic, I could have $2.5 million because it might go up 5x. But that's the thing, right? Diversification is actually key to allowing you to grow that money, or at least continue to have that money stay maybe at a principal and still just draw the income from that. Because there is also the chance that if you put that $500,000 into Bitcoin, it could become $100,000 or $0 tomorrow, right? I mean, to be upfront, it probably won't be $0, but it could lose quite a lot of value. And so if you look at this across different sectors, what you realize is that no sector actually really performs or outperforms the market over a long period of time. And so diversifying across different assets using specific products, including Endowus, where we have a globally diversified portfolio, is actually key. The fourth thing is about not trying to time the market. And what I mean here is you're not smarter than the market. So say you pull out that $500,000, it's not to say, hey, I think I should wait for 2 months and then I put the money and dump it all in, right? Because you don't know when the market is going to go up and down. And this chart illustrates that because it shows that basically for someone who invested in the stock market over a 50-year period, if they had missed the one best performing day, they would be down about $13,000. If they had missed the 25 best days in the market, they would be down $94,000. And can you imagine, this is over a 50-year period. And so being able to invest over the long term is actually what matters. It is time in the markets and not timing the market. So just showing here, the worst investor in the world, this is an article that we did in the Business Times a while back, invest at the peak or the top of the market in every decade from 1970 to today, right? We're during COVID times. And this is the thing. If this person had invested at the peak of the market, okay, the peak of the market, they would still have a return of 8.74% a year. And so when you pull out that money for your home equity loan, you still have 20 or 30 years to utilize that money. And I think what we espouse here is really putting it in a portfolio or product. For example, we have our income product. So say if you pull out, let's be a bit more generous, you pull out $1 million a year, okay? You pull out $1 million. We have portfolios that say pay 5% a year, which means you have $50,000 a year, which you can actually utilize just for your living expenses while not touching the principal. And that allows you to maximize the utilization of that money over a long period of time and not worry about the volatility that comes from the market, where you see that $1 million going to 800,000 to 1.2 and back and forth, but rather getting that steady flow of cash. And so being able to utilize the combination of both that home equity loan as well as this is really good. So investing that money is making it a habit and really investing it now so that you have enough money for the future is really important. At the end of the day, whether you're 55 or 25, time is still on your side. Again, as I said, sure, some people are closer to kicking the bucket, but we still all have a long period of time, especially with the lifespan in Singapore. Okay? The longer you invest, the more stable the return. And it really is something to think about when you're looking at managing your money over the long term. And when you pull out a huge chunk of change from your property, spending your money properly, investing your money properly so that you can live better today, tomorrow, and into the future. All right. Okay. Thank you very much.
Oh, that was cool. Nice. Very
Yes.
good sharing.
Okay, so I guess in terms of questions, we can actually go right into that. Let me just take a quick look. Okay, there are quite a few. There are a couple. Oh, actually, it is the same questions. Do we have any more new questions?
I think there wasn't any questions, but it was answered already. Yeah, I think one of the questions that popped up when you were talking about, what's the benefits of using cash instead if I can top up my SRS and invest using that. Yeah. So I
Okay,
think-
it was already answered. Okay, fantastic. Okay, great. So if anyone has any other questions, we have 3 more minutes. Happy to answer 1 or 2 more questions, and then we'll close off. But we're cognizant that it's the top of the hour, so we want people to go back, but go home. I guess you're all at home, but maybe Clive wants to. Oh, I want to. But okay, one question here. I'm looking at 2 options now: to buy an HDB flat with a few $100,000 cash left to invest with Endowus, or to buy a condo apartment, then later extract equity. So I tell you what, Clive, I'll talk about it from the pros from an Endowus perspective, and then maybe you can talk a bit about it from that. So I think at the end of the day, actually, if you can answer your own question, I'm just wondering, how old are you at the moment? Because actually age does take a bit of that does matter a little bit. Mr. or Mrs. Anonymous or Madam Anonymous. I was just wondering if you could just put your age, because you're anonymous, so no one knows who you are. Okay, 43. Okay, got it. Okay, thanks so much. So I think in terms of utilizing that cash, a few $100,000, I think. Wait, sorry. One more question. What property do you currently own? Because I realized that there's a few. Just wondering what property you might currently own, whether it's nothing or whether you're looking to buy an HDB, or whether you're looking to buy an HDB or condo. But I guess if you don't have,
might be looking to purchase the first property.
Yeah. Okay. Got it. So actually, I'll look at, I'll talk about this a bit from just divorce will sell house. Okay. Understood. Okay. So I think from that perspective, it really depends on what you are looking to do, right? So, look, I think I'm happy to share a bit about this from I think a personal angle, but also from a professional angle. I mean, to be upfront, it's always nice to have a roof over your head, right? I think that actually does matter to a certain extent. So, I mean, that's definitely a consideration. But having said that, I think Clive can maybe talk about whether you want to stretch yourself or not with a HDB or condo.
Yes.
But from an Endowus perspective, from a cash perspective, you actually can invest that money into a portfolio, which would again give you an income, and so you can use that income to cover both your, say, example, rental, and then you can use the rest of the cash to save that, right? So just as an example, if you invest that money and you're getting $5,000 a month from that, and I think that's actually quite reasonable, or maybe $4,000 or $5,000, you can use that to live, and then any money that you get from your salary, say you're making another $5,000 a month, you can actually use that for savings also. So what you're doing there is you are utilizing the cash that you have in hand to generate income for you, and you're able to save your income. And I think that's a good way to look at that. But Clive, over to you.
Well, we can go on for hours and hours, when with this kind of questions, to be honest, because there are many variables and there are many things they can ask you. So, but do consider this, right? Now, if you're buying a condo today, it is not always going to be the case where, okay, I bought the condo and 3 months later, I'm going to extract equity from it. It doesn't really work that way. It really depends on whether the property, whether you're buying the property at valuation, above valuation or under valuation. So that's only one consideration of the considerations of the many other considerations. The other thing is this: buying properties in order to extract value, it just means that the property has to appreciate in capital, right? Either that or you take a lesser loan or you don't use so much CPF. But generally, what gives you additional equity is the capital appreciation. So it also then comes down to, hey, what kind of condo are you going to buy? What is your budget going to be, for example? Because your budget would then determine, where you're going to buy, or where you can look at whether it's going to be a 1-room, 2-bedder, 3-bedder. That would make a difference, for example, in how the property would perform as well. So we don't want to just naturally assume that, okay, if I buy a private property, I'll always be able to extract equity from it. It's not true, right? There must be certain conditions that are met in order for you to extract equity from that. So in the meantime, maybe in the next 2-3 years, you might not be able to extract equity from the property. So then what are your considerations? Then what are your priorities? Then if your priority is that, I just want to, I want to start having a passive income as soon as possible, then perhaps buying a HDB, something with a lower quantum, and investing the rest of the cash that can, give you a passive income, for example, small amounts of passive income, might be the strategy that you want to deploy. So without understanding your requirements, without understanding what, where these properties are going to be located, what kind of properties are you going to buy, it's really difficult to advise you on the spot. But these are the considerations that we must think about. And it's not instantaneous that, we buy into a property and tomorrow we can extract equity from it. Yeah, so that's how I answer this. I think
All right. I think we are just right at the top of the hour. I'll answer one
Yeah.
last question really quickly. I think Xingxi answered one question for you, Clive.
Sure.
I think, what can I invest in Endowus that will help me get returns when I take a loan from the property? So I think, look, all investment comes with risk, and I'm not going to try and dilute that. And so you can look at it from the perspective of investing in something that might be a bit more less risky, right? So Endowus has different portfolios from 100% equities and 0% fixed income to 100% fixed income and 0% equity, and everything in between. So I think if you're looking at something that's a bit more stable, perhaps you can go with a balanced portfolio that might be 60% equities and 40% fixed income. Or again, you can choose one of our equity portfolios that pay anywhere from 3 to 6%. That might help you out with that. But no, I think we're just at the top of the hour. So if you guys have any questions, you can please feel free to reach out to me or to Clive in private, and we'll be more than happy to answer any of those questions. But any just quick last words, Clive?
Yeah, I think I would, because there are 2 other questions that came out, I can answer them within 30 seconds if you don't mind.
30%.
First question is, 30 seconds. Are you sure joint purchase Singapore citizen and Singapore PR doesn't incur additional buyer stamp duty? Yes, it doesn't incur if they're buying this as a matrimonial property, so they have to be married. The last one is decoupling purchase as a US citizen who is a Singapore PR given the same treatment as Singapore citizen. Under the free trade agreement, the US citizen will be given the same treatment as a Singapore citizen. So that's 30 seconds.
Well, I think it was less than 30 seconds. But all right, thanks so much, Clive. I really enjoyed chatting with you, and I actually learned quite a lot because I also have been in the same situation with my property too. So great learning there, and I will be reaching out to you privately also to ask you more questions.
Thank you so much for having me here. I really learned a lot from you as well, and really glad to be able to share.
All right. Thanks so much for joining us at our Endowus Access webinar tonight, everyone. Have a good evening.
Thanks, everyone. Take care. Good night.